In commercial real estate, the deal is rarely the thing that kills you. What kills you is the gap between the risk you took and the balance sheet you had behind it. That is why I care so much about the personal financial statement. For an investment or development entrepreneur, it is not administrative paperwork. It is not something you throw together for a lender at the last minute. It is not a static snapshot of wealth. It is your operating reality. It tells you how much risk you can actually carry, how long you can stay in the fight, how many mistakes you can survive, and whether a bad outcome is a setback, a scar, or a wipeout. Most people in this business spend their time talking about upside, purchase price, basis, rent growth, yield on cost, exit cap, promote structure, all important. But those are deal mechanics. The deeper question is simpler. What happens if you are wrong? That answer lives on the personal balance sheet. When I think about a real estate entrepreneur's personal financial position, I reduce it to two variables. Capacity is the financial ability to absorb risk. That means liquidity, net worth, recurring cash flow, debt load, contingent liabilities, guarantees, concentration, and access to capital. Temperament is the willingness to bear risk. That means how much illiquidity you can tolerate, how much volatility you can stomach, how comfortable you are signing recourse, and how calmly you can operate when a project stops going according to plan. Those two forces determine how you will behave when the market turns against you, and they create four very different modes of operation: preserve, expose, reserve, attack. Low capacity, low temperament. Preserve. This is the quadrant no one brags about, and many people should respect more. You do less. You keep leverage modest. You avoid speculative construction. You stay away from deals that require perfect execution. You do not stack personal guarantees across multiple projects. You preserve cash. You simplify your life. You buy time. Why? Because you do not have the balance sheet to absorb a real hit, a delayed lease-up, a blown budget, a failed refinance, a capital call, a legal problem, a major vacancy. Any one of those can move from deal issue to personal issue very quickly. In this mode, caution is not cowardice, it is accuracy. You are not playing offense because your first job is survival. Low capacity, high temperament. Expose. This is where people get hurt. They want scale before they have strength. They want development before they have reserves. They want the larger deal, the thinner spread, the bridge loan, the floating rate leverage, the aggressive business plan. The ambition is understandable. The math is not. This is the entrepreneur who wants to swing like an institution while living like an individual. The posture says, go. The balance sheet says, you cannot afford to miss. That mismatch is lethal. In commercial real estate, things go wrong in slow motion until they go wrong all at once. A rate move, a permit delay, a contractor dispute, a lender retrade, a partner default, an exit that disappears. If your personal balance sheet cannot absorb those shocks, then you are not taking measured risk. You are placing your future on a structure that has no margin for failure. That is not conviction, it is exposure. High capacity, low temperament. Reserve. This is strength expressed as discipline. You have real liquidity, real net worth, real staying power. You could stretch, you could press, you could chase. Instead, you stay selective. You pass on marginal deals. You underwrite conservatively. You keep cash available. You do not let urgency dictate pricing. You wait while others convince themselves that discipline is indecision. This is one of the most misunderstood positions in the business. People mistake patience for passivity. It is not. It is optionality. A strong personal balance sheet allows you to do nothing when doing nothing is the highest return decision available. That is power. You are not forced to transact. You are not forced to refinance badly. You are not forced to raise capital on weak terms. You are not forced to sell at the wrong moment. You can wait because you can afford to wait. And in real estate, the ability to wait is often more valuable than the ability to predict. High capacity, high temperament, attack. This is where extraordinary outcomes are made. Not in easy markets, not when capital is abundant, not when everyone feels rich. In stressed markets. This quadrant belongs to the entrepreneur whose personal financial statement is strong enough to turn market dislocation into opportunity. You can close when others stall. You can carry a project when others are forced to hand back keys. You can write the check that keeps the deal alive. You can sign the guarantee intelligently because it does not consume you. You can buy when lenders are defensive, sellers are tired, and competitors are repairing damage. This is the real advantage of a fortress balance sheet. Not safety for its own sake, but the ability to be aggressive precisely when aggression is most rewarded. Anyone can look bold in an easy market. The real test is whether you can move when the environment becomes hostile. That is when pricing improves. That is when negotiating leverage shifts. That is when weak hands disappear. That is when the opportunity set becomes asymmetric. And that is when the entrepreneur with personal liquidity, resilience, and composure has a weapon no spreadsheet can manufacture. Every real estate entrepreneur eventually discovers the same truth. The market does not care how smart you are. It does not care how compelling the pitch deck is. It does not care how badly you want the upside. At some point, something breaks. A deal runs late, costs move, debt resets, equity dries up, a tenant leaves, a maturity arrives at the wrong time. A guarantee becomes real. When that happens, the winners are not always the most ambitious people in the room. They are the people whose personal balance sheet gave them room to survive, room to choose, and room to strike. That is why I do not view the personal financial statement as a compliance document. I view it as a strategic map. It tells you whether you need to protect, whether you are dangerously overextended, whether you have earned the right to be patient, or whether you are positioned to attack when the market gives you an opening. In commercial real estate, a fortress personal balance sheet is not about playing defense forever. It is about making sure you are still standing when the best opportunities finally appear. And when they do, it is the entrepreneur with strength, not just vision, who gets to take them.